So by the end of this video, you're going to understand the one financial ratio that's disqualifying millions of Americans from buying their dream home. And you'll also know how to calculate it all in under 60 seconds. This is also the same formula that the banks use in order to determine if they're going to approve or deny your loan, even if you have excellent credit or an excellent down payment. This is also the reason why those with six-figure incomes are getting denied every single day. But here's the catch. If you don't understand this, or if you calculate it wrong, this could cost you your dream home. Now let's break it down. Okay, so your debt to income ratio, this is the formula that the banks use to determine how much of your monthly income goes towards your monthly debt in a percentage. And what they look at is all of your monthly debt added up. They divide it by your gross monthly income, so your income pre-tax, and that's going to give you your DTI in a decimal, and then you multiply that by 100 to get the percentage. And it's important to understand that they are not really looking at the total outstanding balance. They are strictly looking at all the monthly payments added up. Typically speaking, the lender, depending on what type of loan program you're doing, they want your DTI to not exceed anywhere from about 45% to 56%. And here's the thing, a lot of times people assume that just because they have a good credit score automatically means that they're going to get approved by the bank, and this is not the case. Just because you have an 800 credit score but you have a really high DTI, you're not going to get approved. And on the other end, this is how some people with the low 600 credit score are getting approved because they have a really low debt to income ratio, so the banks are more inclined to lend to them. So it's really important to know what your DTI ratio is up front. So if you need to make some adjustments like paying down credit cards, paying off any of your monthly debt, this gives you time. Now here's the thing, it's not just enough for you to know how to do this formula, you also need to understand how the banks look at this in order to calculate how much buying power you have. Okay, so there's really two ways that lenders determine your debt to income ratio. Number one, they look at what's called your front end DTI, which is really your future mortgage payment, including the estimated taxes, insurance, HOA, divided by your gross monthly income. Then they also look at what's called your back end DTI, which is going to be all of your monthly debt, including that future mortgage payment, divided by your gross monthly income. And what they do is they put both of these calculations into the system, and whichever one caps out first is how much they'll limit you on your buying power. So here's an example, a real life example of how it works. So let's say you have a combined household income of $10,000 a month. So they'll allow, generally speaking, about 50% of that monthly income to go towards your monthly debt. So they'll allow $5,000 of your monthly income to go towards your debt. Now, this $5,000, a common mistake people think is that this is allotted to just your current monthly debt. No, this has to include the future mortgage payment as well. So let's just say, generally speaking, you have about $2,500 of your monthly debt, including like credit cards, car payments, student loans, things like that. So that leaves us with about $2,500 of that to go towards your future mortgage payment, which depending on the rate and the down payment and everything, that's on estimate going to be around $350 to $375. So this number, it's very variable based on your situation. So try to do it and see where your debt to income ratio lands. And before we get into the next step, which can determine if it makes or breaks you getting approved or denied, make sure you hit that subscribe button if you're planning to buy a house in 2025. All of your monthly debt and include it. What they mainly care about is what's going to be on your credit report and what you are legally obligated to pay. So what they're going to include is going to be your car payment. It's going to be your credit card bills. What they're going to look at is your minimum monthly payment on that. Then they're also going to take a look at your student loans. Now here's the thing with student loans. If they are deferred, they are not going to use a $0 for a monthly payment for that. They're going to use a 0.5% of the total outstanding balance that you owe, and that's going to be the replacement holder for the monthly payment. Now, a way around this is if you are on an income-driven repayment plan, they will accept that. Now, they look at your child support, if you're paying child support, any alimony, any like IRS repayment plan that you are, that's pretty much, and also personal loan, that's pretty much all that they will include as monthly debt. Now, here's what they don't include. They don't look at your rent and include that. They don't look at your cell phone, any insurance, grocery bills, gas, things along that line. And the common mistake that I see a lot of people make is they include all of this into their monthly debt to income ratio, and they think that they'll automatically get disqualified, and that's not the case. Now, let's go over some real life examples of how the debt to income ratio comes into play. Okay, so we're going to compare two real life scenarios so you can really see how much of your monthly debt can affect how much buying power you have. So we're going to stick to the example of $10,000 a month of monthly gross income. And let's say you have $1,000 of monthly debt, you have a $500 car payment, a $500 credit card bill. So what you can do, you're going to take your monthly income, you're going to minus all of your monthly debt. That's going to give you $9,000 a month of disposable income. And remember, the bank only really allows you to use up to 50% of your disposable income. So that's going to leave about $4,500 a month to use to allocate towards your future mortgage payment. So on average, that monthly mortgage payment, if you're putting down the minimum down payment, you could probably get approved in this scenario anywhere from about $550 to maybe about $600K. Now, let's do the same scenario, but let's say instead of $1,000 in monthly debt, you have $3,000. So you minus the two, that gives us $7,000 of disposable income. You're going to divide it by 2 because that's how much the bank really allows you to take, and we have $3,500 a month to go towards, to be allocated towards your monthly mortgage payment. And on average, that's going to give you an approval amount of anywhere from $400 to $450. So if you can see, there's almost about a $150,000 to almost $200,000 of buying power difference in the difference of the monthly debt. And a big mistake that I see people making is they think that they just need to make more or get a higher paying job, when in reality, they might just need to pay down some debt, and that can help them qualify for more. So what I suggest you to do, make a list of all of your monthly payments and see if your DTI will be in line, or see if there's something that you can pay down or get taken off that will increase your buying power. Now, here's the thing, just because the bank approves you for a certain amount doesn't mean it's a smart financial move for you to take all of that amount. So we're gonna go over some budgeting tips. So at the end of the day, you have to remember that the lenders work for the bank and they are not your financial advisors. So your pre-approval is strictly based on the risk analysis that the banks spit out an approval for, and then it's not based on what your overall financial goals are, and also if your retirement plans as well. And remember, the lenders do not calculate everything of your total monthly debt into the equation, just what's on your credit reports and what you're legally obliged to. But again, they don't take a look at, what you're paying as far as daycare, as far as the overall cost of your living expense. So you have to take that into consideration for yourself. And a common mistake that I see is I see a lot of people allow the lenders to determine how much affordability you have or how much you're pre-approved for. And this is how you become house poor, when you allow the banks to decide that for yourself. So what you need to do is make sure that you know your budget up front. Make sure you really understand what's your max amount, how much you're comfortable spending towards your mortgage payment. And when you're getting pre-approved, make sure that you tell your lender this so that they can adjust your pre-approval based on how much you want to spend. So here's how you can take action. Number one, run the numbers yourself. And what you can do is take your monthly income minus your monthly debt, then divide that number by 2, and that's going to give you your allotted mortgage payment that the bank is going to allow you to take. See if that number is doable for you. See if that's maxed out, that's going to cause you to be house poor, or run different scenarios. Also, look at your current debt and see what you can pay down. Generally speaking, the best way to take action is if you have a low balance on a card or a loan and a high monthly payment. Those are going to be the best to eliminate first. And then also make sure that when you do get pre-approved, talk through different scenarios with your lender to make sure that they're pre-approving you based on where you want to be as far as monthly payment. And if you like this video, then you're going to love the video that I did on the 5 simple steps to buy a home with no money down.